Hey, good morning, everybody. You're still
I
on mute.
said yes. It's been a while, but yeah, it's great to see you. How you been?
Good, good.
Hello, hello.
Well, what's
Hey,
up?
Emmanuel. Good to see you. Glad you showed up since your question sparked this.
Yeah.
Although, although um, I'm doing a podcast this week on Only Land Fans with which is Kindle's. He's one of our members here too, which is his podcast. And he reached out to me a couple of weeks ago and asked me to do a podcast on this very topic. So then when you came in, Manuel, with a question, I said, you know what, I can give a more detailed, more in-depth presentation to you all than I can on a podcast because I can't use visuals. So it's actually better this way. So I'm going to give you guys the first kind of like the first round of this, and it'll go deeper than what I'm probably going to get onto into just a public podcast. Um, any questions before we begin? We'll let some other people come in.
Well, where are these recordings posted?
Um, the ones that I post, okay, because I don't post all of them, but I post some of them. Like this one will be posted because it's more of an in-depth training.
Gotcha.
So they get posted into the guides in the Facebook group under guide number 5, which is our called the title of that archive is archive um, videos, or I've the name archive something. I forget what I named exactly, but that's where they are.
Okay, I've seen Guide 5 and I've seen the archive. I just haven't seen all of them, so I wasn't sure.
Yeah, yeah, they don't all make it. So if a lot of times I recover the same information that's already in the other videos. So in that case, generally I won't post them. Although there'll always be a little bit that you're going to miss if you don't come to the live event, but nothing that's will affect your business. So if it affects your business, I'm always going to put it into the, I'll store it as a recording inside the archive or under one of the particular subject matters that we cover in there.
Okay, perfect.
Okay. So let's jump into this. So the general question is for Manuel is, um, do we change anything, as we go into a recession? And are we going into a recession to begin with? Because, we've had talk of recession, right, for several years now. So is that actually a thing or not, or what? Um, and then if that is so, then what are some of the ideas or changes that we might have to do with our real estate or a particular land flipping business? And or should we add some other elements to it? Maybe we do some house, maybe we do something else. Okay. So so let me preface this first of all by saying that a lot of the material that I've already covered in the last, I'm going to say 2 years now, it was I saw the changes in April of 22, I think, is when 22, 23. Yeah, 22 is when I started, I believe, teaching. No, it might have been April of, well, I don't know. We'll have to go back and look at it. But anyway, I've been teaching it for years now, at least a couple of years in, based upon, okay, we're going to assume that we're going to hit a recession. And I'll explain that why I came up with that to begin with back then. I think it was 21. Um, and um, basically, if a recession hits or when a recession hits, what do we do? All right. So we were doing great on cash. We buy for cash, we sell for cash, and and that will never go away. Okay, it's just the numbers of of what you're doing, cash versus something else, which is either they don't have cash or we have to come up with a different way of selling property because they don't have cash. which means sometimes we have to come up with a different way of buying the property because we're not going to have cash. So, and the only viable option that's ever been in the market and has always been there, and I've been doing it since 1982, has been owner financing. So we're in a cash market, or we're in a combination of cash and or owner financing at any given time. So at the top of COVID, or when COVID hit, as you all remember, if you were here, it was so simple to sell land. All you had to do is throw it up, and somebody would come along and offer you cash for it, and sometimes more. So it was, the administration flooded the market with money. They put in like $3 trillion in 2020, which is why we had that big burst. In 2020, the Biden administration came in, took over, and they seeded $3 trillion into the economy. Now that's cash going into the economy. So it went into businesses, PPC loans, whatever it was, it went into the economy. And so everybody got flush with cash. It was just cash everywhere. As a result, for, about a year and a half there, everything sold, and everything sold at tip top price. Then as a result of that, a lot of the property tax assessors came along and said, oh, look at these tip top prices. What a great opportunity for us to go ahead and, redo our numbers and make them at this tip top numbers, whatever we could come up with as far as what our top sales were. That's what we're going to price the land now as valued at, and houses. That they did to everything across the board, especially in Texas. So in Texas, we had these people that got in control of at the state level of the county tax laws and stuff, and started allowing and pushing for more property tax, even to the point where now it was illegal what they were doing, and now they're paying the consequences because there's some lawsuits flying and people are getting in trouble because of what they did. So yeah, they've got to pay the piper now, and that's fine. But the problem is we're still stuck with these really high, tax valuations on property that really aren't there anymore. So that's the thing that what's one issue. Now it's not a big issue because we'll cover that when we get there. But that is something that did happen as a result of COVID and the COVID money. And quite frankly, we're not going to see those days again in your lifetime. That was a once in a lifetime thing. I've never seen it before. We've never had a reason to put that much cash into the economy. It's never been done before. It was kind of crazy. It shouldn't have been done also, because now we're paying the price in inflation, right? So that's the give and take. They put all this cash out. It just kept pushing prices up, and people overpaid, and everything went high. And then now there's, it's still going high. Hopefully we see now it's getting in check a little bit, but now it's too late because everything has gone up 20-30% in price. And unfortunately, everybody's paycheck didn't go up. So now our general population of buyers out there, people who buy our land, people who buy our houses, can't afford to buy now. So that's kind of where we're at. So that brings up that option of owner financing. And I'm going to go into a couple of different ways of owner financing and how you should be pursuing that a little bit later on. What I want to do real quick is to show you how you can, because I'm not always going to be here, right? But going forward for the rest of your life, I'm going to show you how, over the years that I have been able to pick up, how to kind of gauge the market, see what's going to happen, kind of gauge, okay, going forward from here, I think we're going to have to do this. So even when we were at the top of the market, I was already saying, oh, we're in trouble. Well, how did I come up with that? Why did I come up with that? Why did I start planning that and making sure I got all my bases covered instead of waiting till something happens and then scrambling, going broke in the meantime, and scrambling, trying to figure out, hey, how am I going to survive this new change in the market? So you've got to be able to anticipate the market. I'm going to show you how I do it, how I've learned through the years to be able to do it. And also you'll get a good economic lesson today on the economy, how it works and why it works. And um, it'll help you make better decisions all the way around about everything. Okay, so I'm going to go ahead and open up my screen. I'm going to start with, let's start with builders, just to show you a concept. So in this concept, we're talking about the market, because the real estate market and what happens in the bond market is the relationship. It's not what happens in the stock market per se. Okay. Sometimes, yeah, you'll see the real estate market follow the stock market, but it's always slower than the stock market. So this first thing I want you, if you're taking notes, this is one of those key things that you need to keep in mind always. It'll keep you out of trouble. Is that just because the stock market crashes doesn't mean home prices will come crashing at the same time. And here's why. This is the key to write down. The real estate market always follows the stock market by a year or two. So if we see the stock market crash like we did in 2008, it actually bottomed out that next April. So it was like 6 months in and it bottomed out and it was straight up kind of basically from there. But real estate didn't come back until 2011. That means it kept going down. Prices kept going down for 3 years past 2008. So the stock market is a fast moving market. There's cash buyers, cash sellers right there. Boom. They can make, they're doing it by the second, right? Real estate, not so much. It's sellers who say, oh, did we have a crash? I didn't hear about a crash. Yeah, the market crashed 6 months ago. Where have you been? Oh, I didn't know. And I didn't need to sell my house, but now I need to sell my house. So finally, we see a lower price coming in. We also see sellers that say, well, the market should bounce back. It looks like it's bouncing back in the stock market. I hear a lot of good news on the thing. So I'm going to keep my price high. Hopefully the real estate market bounces back, but it doesn't. All right. So you have that element going in that basically lags behind the marketplace. So whatever we're seeing in the stock market, you can't compare it, but there's so many things that are comparable and things that are so similar. And I've invested in stocks and bonds since 1993. So I follow this stuff religiously and have learned a lot of stuff that can take some people like me a lifetime to learn, because nobody's going to tell you this out there. And the people who know are usually the biggest investors out there, like the banks and stuff, and they're not going to tell you. They're betting against you. So that's the way it works. All right. So I'm going to show you what's happening in KBH. Anybody take a guess what KBH is?
KB Home.
Home builder.
All right. We're on the ball. I like it. This is KB Home Builders, right? So here's today. This is where we are today in their stock market. And their stock price right now is $80. It doesn't really matter what the price is. It's what the chart looks like. The price means kind of nothing when we're looking at it and trying to come up with, well, what's going on in the market. What we're looking for is concept. And this concept is created by the institutional buyers. And let me tell you, the stock market is made up of, so that you understand the concept I'm going to cover here. The stock market is made up of two kinds of people, two kinds of investors. One is institutional banking and big funds. These are huge funds. They'll go on, they'll do $1 million trades at a time. They have billions of dollars, and some of them have trillions of dollars invested in the market. Institutional investors are so large, they can invest in the market and then hold that position for years, and they're fine. All they're trying to do is make a return on their money over a period of time, and they have to have their money working. It's got to be working somewhere where they know, hey, I'm going to make a profit at some point. Okay, so the institutional investors exist because of the other type of investor called the retail investor. The retail investor is pretty much everybody else. So it might be a small firm like a equity fund, a hedge fund. They're still doing millions of dollars, but they don't do anywhere near the size of trades that the banks do, which are huge compared to them. And it's also all the way down to you as an individual. If you're trading again, in the stock market, you want to buy a stock today, sell it tomorrow, you're a retail trader. So that makes up a very large bucket of investors. And the institutional investors, there is a very small bucket of investors, but they're so huge, they're actually taking on the risk of these retail investors, and they beat the retail investors every single time. They will basically, for all intents and purposes, they never lose. They might have something here and there. In the long run, it makes no difference. They're going to win in the end, and they always win. Now, why is this? Because if you have so much money that you can buy into a trade and hold it for years, the retail guy can't. They have to churn their money and make a profit every year. That they go in, they come out, and they've got to churn that money in and out. So they can't hold as long as the institutional investor can. Therefore, the institutional wins in the end, because no matter if he buys too high or too low, all he has to do is wait it out, and eventually it comes back. And they have so much money, they can help push it in that direction as well. So there's a lot of advantages to the institutional. So now, how can we use that information, and how is it used in the stock market? Well, we're going to look at KB Homes here. And back in 2005 to 2007, right here, this was the peak of the market. Now, in 2005, I started telling our members, wait a minute, I'm seeing some problems in the marketplace. We have a slowdown in sales. They aren't going as fast as they've been going for the last 4 or 5 years. So we had a nice, good, steady market, everything in and out, done. Suddenly it started to stall a little in 2006 is when it started to stall. And when I made that announcement, by 2007, it had gotten to where there was a lot of areas across the United States where prices were contracting. They were being reduced. They were going down. Now, at this point, I'm telling everybody, hey, if you are holding real estate, you own the real estate. It might be rentals. It might be just a long-term investment. Now's a good time to sell, because we're in a market that's going to correct. All right, so we then had the stock market crash. And what happened was this. So along with the stock market crashing, it takes money out of the economy. It creates issues with interest rates and all kinds of stuff that come up, and why the Fed has to address it and everything. And again, for us, they can fix the stock market, which they did fairly quickly. But this is basically what happened to pricing with houses, whether you were selling a used house or whether you're selling a brand new house. You see, it's the same thing. That's because the economy, people are not getting loans. So they got beat up so bad out of the 2008 crash, they couldn't afford to go buy a house. So even though interest rates came down, they still couldn't afford to buy a house. And as a result, prices continued to drop until they got low enough and people start to solidify their income and get their credit repaired, all that kind of thing, which typically also takes a couple of years. Then the housing market finally came back. So this is why we have a crash, which I'm anticipating we will coming up over the next year. It could be in a couple of months. It could be, right after the election. It could be right before the election. Okay. With this happened here in 2008, it happened 2 months before the election. When we finally knew for sure Obama was going to be elected in and Bush was going to be going out, the money markets froze. The entire month of August, there was no mortgages being approved. Every mortgage was put on a freeze. Now, they didn't make this announcement, but being a mortgage broker, I saw it. Most mortgage brokers, if you're listening to this, that's what happened that month. Suddenly, your mortgage got put on hold. They didn't know what was going to happen. They thought the world came to an end as far as the money goes. All the note buying dried up like that. All the money for note buying gone overnight. So it was a very difficult month to get through. I came out and told our members what was going on. And again, now it's like, okay, you might have, now it's too late. I mean, if you find a cash buyer, you're okay, but now it's too late. You can't get out. You're going to be stuck with your property as whatever. Now, you still had a little room to go ahead and drop your price and get out, which the smart people did. So on the way down over the next year, the smart people drop their price just to get it sold and they're out. The dumb people, the dumb sellers were saying, okay, the stock market's come back in and all the news media is telling me everything's going to be okay now. So I'm going to wait for it to come back, wait for the prices to come back. But look, they never did. So prices never came back in. And they kept going down, kept getting worse and worse and worse. And we got down here into some major pain. In October of 2011, I made a video. It's on YouTube still. It's the only time you'll see me in a suit and tie. So if you see that video, that's the one I made in October of 2011, saying, okay, we're at the bottom for houses. Now's the time to start buying houses. Fix and flip people, rental people. This is your day. This is when you need to go back into work. Okay. So how did I pick that time? Okay. I'm going to show you based upon the bond market in another slide, but I want to get through this concept first. All right. So what happens is the markets go down, but then suddenly the market goes up. And why did it go all the way up to here? Okay. Here's a secret. Now, this is what most people don't understand about the stock market. Remember those institutional people that I told you about, the investors? All right. So what happens is with all stocks across the board, they have to exist because they're required by law. We call some of these market makers, and they're basically employed by the institutionals, okay, to be on the other side of every transaction. So even if this stock is going down, anybody with their right mind knows not to buy this stock. How about right here? Would you buy this stock at this point? Like right in here? You see kind of where it's at right here? You see what's going on. You hear the bad news. You know we just went through a horrible crash. Are you buying this stock thinking home prices are going to bounce back because you're an investor and you think everything's going to be great? Well, if you're in the stock market trade, you understand charting and you understand some basic ideas about charting. And when you see something like this where a price continues to take out the bottom of something that made a bottom before and went back up, okay, that tells you it's going to continue to go down in all probability. Not always, but in all probability. So you won't buy this. So that's why we have the institutional buyers. They have to buy it. So are they crazy to buy it? They would be if they couldn't wait us out. In this case, they had to wait from 2007 all the way to a few years ago to get their money back. That's how long they have their money invested sometimes. Okay, so they don't care. And again, in all these ups and downs, they can make more money anyway. So it's not like that. They're always going to be protected by that. And it's a dynamic where they eventually get into a position where they start actually buying down here, because now they see, okay, if things are changing around, now we're going to really buy, and we're going to push it all the way back up so that we get all of our money back that we had to spend up here on this investment. We're going to get it back here. Plus we're going to make a profit. So this is a concept that happens on every stock. If you pull up any stock chart, you're going to see this U shape. So I call it a U method. It's where prices have to take a change. Okay, because right here, either prices can go up higher or it can go down lower. If it goes down lower, it has to come back up here, right here, where only an idiot would buy. All right. So nobody wants to buy stock here except an institutional that can wait out possibly years for it to come back here. But we also know, okay, well, it's headed in that direction. Institutional buyers are going to be buying. Smart retail sellers just selling. They're making money all the way down. And of course, some of them get clipped right here and they lost a bunch of money right here. The institutionals, you know, that were still buying down here, when it came back up here, they sold a bunch, and they probably made all their money back here, but they won't make it all back. There's still money sitting here waiting. It's called liquidity, and it's waiting for the price to actually go through that and above it to make profit. Some of this, when you might have to go back and listen to this recording to understand, but I'm giving you the basics of, actually, if you did want to do stock, I'm giving you all the basics you need to make money in the stock market as well. But I hope you don't do that. It's very, very difficult to do it, because you got these guys. You've got these guys that you're betting against who's always going to win. All right. So anyway, what happens is they waited all this out. So it came back up here, and it came back up here and made a profit. We don't count any of this up here as institutional buying, even though they were still buying here, because they made it all back right here, right? So you had this, and you had this. So it's there is a little mini U right here. So it went here, it went down, and went back up. So this U is completed. Anytime a U is completed, it goes away. It no longer exists. So now we look at, okay, well, now after this has been completed, where does the new price begin? It's going to begin above this U shape, or it's going to begin below the U shape. And wherever it goes, in this case, it went down. This now forms the top lip of the new U. So we had a line across here. That's what we would see. We would see a U shape type thing right there. And let me show you what that looks like. All right. So right here is where a U is completed. This line right here is one U. It was from here all the way down, and it came back here and was completed here. There was and as you can see, so there was a U here, and that was completed, a little U in here, and it went back down to here. So at this point, price can only go in one of two ways. It's going to go outside of this U. It can go back up here and continue up, and now it's outside this U, or it can go down, which is what it did. And in this case, because it went down, it means it has to come back to this point at some place, because now the institutional investors are upside down. They actually had to buy stock here, and the price went down on them. So the only way they make profit is when this U is completed, and that's when they basically can get out of their position. And that was completed right here. And you see, it just happened on one day that price just zoomed up there and made them even, and they're okay. So now when this U is completed, this U goes away. And now we're looking back at, okay, well, price now from here is still got to come back up here to complete that U shape. All right. And it took a while. I'm sure they took a lot right here, but you know, it finally got right here, and then their profit is above that. So, and we had one more U that happened down here. So we had a U come in here, it went back up here, and so it started here, and that means that from here there's a tiny U which got taken out here. I didn't mark it, but it's right there. And then you had this U right here, which got taken out here. Okay, so this is what happens. It's these U's. All right, now this is a case where it's a U, But remember, there's also the opposite. There's where prices go up and then they have to come back to make the institutional whole. So we see a mini version of that here, right? This little up and down. That would be like instead of a U, that's like an N. So we have prices here, it goes up, and it's got to come back down to complete the N. So you got U's and N's all through the market. They'll have to be completed. So even when the price is right here, I could look at it and say, you know what? There is no more, stagnant areas in here, no more U's. So I already know that it has to come up here to the top. So I could already anticipate, okay, well, the builders are going to still continue to have a great time. Prices are still going to work for them. Right in here, they had to figure out, hey, we can do a rate reduction. And they just kept going because people were still buying. All right, so now we've got here and we've completed the U and we're stuck right here. So here's the question. The question is, will price, now that this U has been completed, and this is the builder stock, and it's representative of real estate, will it continue to go up? And now we start an N, right? We start an N that goes up and down like this, up and down, and comes back to this point, has to come back to this point because we know where price has to come back to. Which means we could have continued housing market and real estate market could be great. And then finally it comes back down. Okay. And then that would complete that in. And then now we're faced again with, well, now what will price do? Will it continue to go up or will it continue to go down? And if we see it go down from there, we know, okay, we're in real trouble. But here's the issue. We're going to look at other things in the marketplace, and now we get a better understanding of how to bet this thing, how to bet and understand and predict where the market's going to go, what is going to happen to the home builders right now, what's going to happen to real estate prices right now. All right, so let's take a look at that. And that is called the bond prices. This is called the 10-year bond. And this is the most important chart if you want to predict the market, see what's going on. Home builder prices, you can't always tell because some of them doubled they split their stock. So you don't always have a really clean looking stock like KB Homes, like Lennar. Sometimes they just grew exponentially, and that doesn't work. KB just happened to be all over it, even at that time. And so, they were an easy stock to look at, but generally you can't look at those stocks like that. You have to look at them on a smaller time frame and kind of go, but you don't need to because of the bonds. So the bonds are always going to tell us what's going on and predicted everything that went on with the KB stock, predicted pretty much everything we've ever seen in this that goes on in the economy. Now, I say it predicts it, but there's twofold to this. What happens with the Fed and the interest rate is what dictates what happens with the bonds. But I want you to remember this. Behind the bonds, which is the biggest market out there. Remember, we had institutional buyers for the stocks, and we have institutionals in here as well, but we also have the federal government on this one. So now it's even bigger, and this is the big tank. So it's even more accurate than anything you're ever going to see on any chart anywhere. This is the 10-year bond is the most important chart when we're looking at real estate. What's going to happen? Where is it going to go? What's going on? And when you understand that U and the N idea, okay, the U and the N, and we can see it just took place. It just finished, just took place. Okay, this was back in 2007 and 2008 when it crashed, and they started to lower interest rates to pull the economy out of the problem it was in. So here they were lowering rates to try to get the economy going again, try and get credit, try and get people buying and selling again. Okay, and it took for the real estate market, it took all the way up to right here. before that would happen, 2011. I'm going to take an interactive chart in a second, and one that I'm going to have you go get so you can look at this yourself. And so it lasted all the way up until here before they got the pricing right and the economy right for real estate. And then we took a little bit of a hit here and back here. But look what happened here at the top of the market. And when COVID hit, what they started to do was raise interest rates. And anytime you raise interest rates, you're pushing the price of bonds down. So bonds are a form of debt. I don't want to confuse you, but just so you understand, this is the bonds that the government issues that they don't have to pay back for 10 years. This debt doesn't come due to them for 10 years. So they're betting 10 years in the future that this price will be high enough to pay everybody back. All right. So, and so the idea here is that they can push interest rates to help the economy. And we're seeing that reflected like a mirror in the bonds. Now, they don't have a choice with bonds because the same dynamics are going on, and the story is there's a story being told in the bonds. So right here, it's really saying that because we bottomed out here, we probably should take a bottom here, and the likelihood of it going further down is not very, very likely, because when you've made a bottom, part of one of the N's or the U's that took place many years ago, that's usually the turning point, because that's where all the investment got put into the market. That's where all the institutional money had to go flow in. And so they were able to make money. They have to bring it back here to make their money, and then it frees it up. And it usually goes back in the direction, especially in the bond market, it's usually going to go up because our economy usually generally gets better and not worse. And so it can get worse, and the worse it gets, they will fight it with interest rates. So the Fed's going to come out and say, okay, economy is getting worse, so we're going to fight it with interest rates. And they're going to lower interest rates. So in July, in July, they had an opportunity to raise the rates, but they didn't. Lower the rates, but they didn't. And they've been basically saying it's going to be September. So there's a strong bet that it will be this month that they actually start or give us a rate lowering, which will create the bond price to go up. So at the same time, they don't want the bonds to go any lower because they're going to lose money if that happens. And they've got to get this bond up because this is the federal government's money and they need this going up, not down. So to do that, now that we've bottomed out, we also have unemployment going up, which they've been fibbing on the numbers to play the stock market and to get Biden through this last year while he was running. And hopefully get reelected. So they play those games too. So they were fudging on the numbers every single month, except maybe a couple of them in the last year. They had to go back and revise the unemployment numbers to the worse. Okay. So somebody did a tally last month and they figured out they lied about almost 1 million jobs over the last year that we didn't have. They said that we had. So they just out and out are lying to us now, trying to keep the market up long enough to get a re-election cycle in. So that's the political games they play. And that's why Powell, in this case, is controlled by the administration. The White House is the one who appoints the federal chairman, and the federal chairman at the end of the day is the one who decides what's going to happen with those rates. So the president can pressure the federal chairman or the Fed chair to raise rates or lower rates, depending on what they're trying to do with the economy. Now, Trump did this with Powell. Powell was also the federal chair under Trump. And you'll notice right here, let me go over here to this interactive chart. You'll notice in 2000, Trump Trump was elected right here. And what we had basically some rate raising, which pushes the bonds down, hurts the economy, it hurts everything, it hurts the stock market mainly. Okay, because you always see this picture when bonds go down, stocks go up. So, but we had a problem here with the interest rate. So we got to the point where Trump told Powell, he said, I think he said right here, he told Powell, okay, we've got to get the stock market going higher because it was starting to go down, from here to here, and he did. So he did a rate cut, and boom, it started the downward trend of bonds, which created upward trends of stock. So in general, remember, if stock market goes up, bonds go down. Bonds go down, stock market goes up. Bonds go up, stock market goes down. It's always the exact opposite. Now, it doesn't happen necessarily on a daily basis, but when you're looking at time over months and years, that's what happens, even weeks. So you can look at this chart and tell what interest rates were what was going on in the economy at that point. So from here to here, bonds went up, which means the interest rates were going down. All right. So we were cutting interest rates here until we got to the top here, where we had the infusion of cash and everything else, and everybody was going crazy. So they were basically having to come in here and they start raising rates. Okay. So we had basically uncontrolled inflation was going on and everything else was happening here. So they're trying to raise the rates to cool down the economy. It was too hot, actually. Okay. So we've been raising rates all the way down to here. When we finally, Powell said, okay, let's go ahead and start lowering rates. And so he started lowering rates here. And now we're back up here to this point. And you can see kind of like how this kind of works. You see it made a perfect U right here from here to here. And if we rounded this all out, because these are points on a chart, from here to here to here, that completed this U. Now we're at an even place where we could go down or we could go up. And guess what we have coming up in a week or so? We have the decision on will Powell raise the rates or lower the rates? So if he lowers the rates, which he should do because everything else in the economy is telling us to, because of the unemployment, we have a problem with the economy. We're going into a recession is basically what the unemployment numbers are telling us. And so he should lower the rates, which will push the bond prices up. And now we've got this thing going up, and we're looking at, okay, well, how high will it go? Well, ultimately, it has to come all the way back up here. You and I both know that based upon that whole U thing, because there's a giant U here. There's a baby U right here. There's a baby U here. There's a bigger U here, which now is completed. So we're back at the start of, okay, does it go down further? Which means our economy basically collapses, which they won't let happen. So Powell has no choice. He has to raise rates. Okay. And could he wait another month? Yeah, he could. And this thing will kind of like bounce around until he decides what to do. And then it starts back in a direction. All right. So but let's assume, based upon what he's already said, okay, he basically said that we're should have a rate coming up, rate cut coming up, and that should start us, back up this cycle. And the cycle will build and may go up and down for a while over a period of, what did we say? What did we look at? What happened over here? Look at it can bounce around. It bounced around until 2011. All right. So this is when they started controlling and try and get the economy back in. And it took all the way to October 11. So it took right here, right there. So it came out above this, completing this U, right? So we were here. Could have still gone down, but it didn't. It came back up here and it went past there. I say once it went past there, 7, 8, 9, and 10. So once it got past there by a good 2 or 3 months, I felt safe in saying, okay, looks like our market will now start pricing on housing will start to go back up and the values will come back in. And I did that based upon this U getting completed. And then we pierced through this U strongly, giving us an indication that we were out of trouble and things are going to start to look better now. And so that's where that prediction came from. So this is the dynamics that take place. And I want to go back and show you this right here. So here's the little stages that completes different U's and U's that were made before. Okay. And these are the stages. Typically price goes up to the stage. It can bounce around here. It can even go down a little bit and then it goes back through. So once it goes through, the next stage is the next one up, which will be this price here. It can bounce around and go back up, bounce around, go back up, or it could just go boom all the way through the top because there's very little back and forth in here. Okay. Very little back and forth here, but there is some liquidity here based upon what happened, which is rare, but it's right here. If you go back through, you can see if you imaginarily draw a line here, there's a little, dilution here or a bunch of activity here where buying and selling is taking place with institutionals, etc. And back here, right here was a low place, which coincided with this line. So we had buyers here and we had buyers here and a bunch of people here in this area. A lot of activity here. So this becomes an area, even though you don't really see a U there. I'm drawing off of U's in the past because believe it or not, they're still, to some degree, they're important to the people in the stock market and becomes a place of resistance or support. Okay, but this line up here and this line up here will be the main areas. And then at some point we should go up above this. You see right here when this U was completed, and then it came back down, it completed this U over here, all right, from here to here. The end, it completed this end right here. And then it took off. It went above this to make a profit for these people who were still having to buy here, didn't want to buy here because, it's a very dangerous place to buy. At any tops, it's dangerous to buy because of why? Because it can do this. It can go down. It can stay down forever. And these people are trapped. They've lost money. They can't get it back. They have to wait, years? But look, it will come back eventually and give them a profit. So this is how the markets work. Almost without exception. Now, there are plenty of exceptions. I say that, but I'm talking about big stocks, main stocks. There's plenty of people that go out of business or their business, fades away and, they never make it to the top. So that's the way the bond market works. And that's what we're facing right now. So based upon this, this likelihood of going down isn't good, isn't likely, meaning interest rates will go down. But remember what happened in 2007. The reason why we get into recessions is because people no longer have enough money to go spend. So now they can't buy it for cash. Their down payments go down. Their monthly payment ability goes down. To buy something for cash goes down, and it can take years to come back. All right. So in the housing market, it can take. Here's the next note. You want to take note. It can take generally 2 years. And even here, when I was teaching this, I was teaching a 2-year because every other crash I'd been through, it took 2 years for the market to come back, real estate market to come back. So the market would be down for 2 years and then it would start to come back. This was the first time it took 3 years, but this was the most serious crash of my lifetime. The others were really more minor crashes compared to this one. So we have a major crash. It may take 3 years, or we have a minor crash. It's probably going to take 2 years, because history is going to repeat itself because of all the dynamics we're talking about, that we've talked about today, to correct the money stuff that's going on in the economy. So, getting back to my point of what I wanted you to write down, home prices bounce back in 2 years to 3 years, but land prices generally take longer. It can take 10 years in some cases for land prices to get back to where they were at, or even going up again. They can stay settled in an area for quite a long time and never go up. And why is that? Because a lot of the builders, a lot of them have already developed out, or they've they're outside the standard things. They're not, they're depending on where they're buying, but only the biggest builders usually survive these recessions. All those small builders go out. So your bigger builders, they can stay in business because they've already bought up a bunch of land, or they can go buy up a large parcel, subdivide it. So they're not buying your little onesies and twosies lots out there, which is generally what your smaller builders do. So the smaller builders are gone. So this is what helps create land prices to stay stagnant at this lower end for longer periods of time. So understand this when you're negotiating, and when you're educating, because sometimes we have to educate these sellers on what's going on with their land prices. Now, I don't think land prices have got to the bottom yet. I don't think real estate prices have got to the bottom yet. So we're right here, right now, which is at the beginning stage of an interest rate rise, where right now every realtor is and mortgage brokers telling their buyers, okay, we're going to have a rate cut, and when it does, you can come in here and get your mortgage. And they think, okay, everything is going to be great. We're going to go right back to where it was a few years ago. And that's not going to happen, because our buyer pool has shrunken to a much smaller pool of people who can afford it. They don't have the money anymore. They're maxed out on their credit card. So we have all-time high on credit card. We have now unemployment. The real unemployment rate is 7%. It's not 4 like they tell us. It's one of those things where they've figured out over the years how to pull out people who were just gave up looking for work. They're out of luck, and so they just gave up after a year or two, and so they don't count them, and they're unemployed. Okay, but in the old days we counted them. So we really have about 7% of unemployment right now, and it's going to get worse. So as we go into a recession, which is, this thing is going up here, we're going to see home prices come down initially. So we could have a little crash there. We can also see as this goes up, what did I say earlier? Stock prices go down. So we can see a stock market crash occur as well. And let's go back here. This is October right here. This is when the stock market this is right here is where the stock market crashed. August, September, October. This is where it crashed, and it sent the bonds up. Okay, so this is what happens, and we're sitting here. Interest rates are going to go up. This goes up. Stock market is going to crash. So the stock market crashed here, and it didn't come back until here. So you can see here it's going down again, which allowed the stock market to come back and start to bounce back, but it didn't help real estate. All right. So here we're seeing the same exact thing. So we could have a crash. We have a market crash here, and then we could see real estate kind of follow. Again, it follows slowly. Let's look at the QQQ. I use QQQ because it's got a lot of stocks across the board as to, the makeup and everything. Let's go into. Takes a while to happen. Okay, so while we're waiting on this, so the idea behind this is now we have to focus on understanding in general that land prices will continue to go down, which means if your idea is to buy land and then wait it out and then sell it later, that's a horrible idea at this point for sure. Because you're going to get trapped, like all these people getting trapped by like an institutional guy. You know, you're going to get trapped, and you're going to have to wait like an institutional guy 10 years maybe before you can get it back. But you can flip all day long. It doesn't matter if prices are going up, down, sideways. It doesn't matter because we're in and out so fast. We're like the retail trader. We're in, we're out. We've made our money. We can work on a little U, you know, a real tiny U. Sometimes it's a couple of weeks long, and we're in and out, and we've made our money. But the second thing is the second thing is the owner financing aspect of it. So the next thing that really comes about and creates a big advantage for us is that after the market bounces back and the sellers see, hey, the real estate market is still going down, now they start to panic and they can start to sell at reduced rates. But again, nobody wants to sell at reduced rates. But what they're willing to do is they're willing to sell on owner financing. And so basically, use our calculator to create the two sides as we've gone through in the training, where we're buying at one level and selling at a higher interest rate, higher down payment, and being able to make that kind of deal come through for you. So that's another way. And of course, the third way is using the note purchase. Now, the note purchase at closing allows you to go in and pay even higher than maybe you would if you were doing a cash buy, which right now, if I were doing a cash buy on a property, I'd be at anywhere from 40 to 50% on the dollar. If they don't want to do that, then you offer them you give them the option of, well, let's owner finance it. And if you're going to owner finance it, ideally you should go in with next to nothing down if you can. A lot of times you can get in with $1,000 or $2,000, even on a $30,000 property. Even on a $60,000 property, you can go in with a couple thousand down and get them to hold the term, 0% interest. And that gives you all kinds of profit that you can make when you turn it on owner financing. And then you're doing a wrap on it, as we've covered in that video in the guides. And then the last one, as I started to say, is the note sell. So in this case, you offer them, say 60 cents on the dollar, maybe you start out at 50 cents and maybe, you negotiate to 60 cents on the dollar. Now you can basically create a note, sell me the note at closing at maybe closer to 70 cents on the dollar for the whole transaction. And you still make, 10,000 or whatever it is on that particular note. So that's another way of being able to make cash offers out there. And next week, we're going to cover more on how to make these offers, how to negotiate better with the sellers or not next week, but next month on these kinds of transactions. All right. Well, all I really wanted to show you on, the general stock market is that the stock market has now made what was called a double top, and the second top wasn't quite as high as the first one. So basically, the stock market has come up here to the top up here, and then it started to make our big U over a long period of time here, over months, and then it came back up here, and it didn't quite make it all the way to the top, and it started to break down. So now we're down here already, and this is where we kind of sit today. So if I could show you, that's what the stock chart would look like, which means we've completed that U, and we are on the way back down, which means the stock market is telling us it's going to go down. The bonds, when we look at the bonds, it's telling us the bonds are going up, which also coincides with the stock market going down. That's right. And Powell is telling us he's going to start to drop the rate, which pushes the bonds up, pushes stock down. All of this is lining up correct. So when everything lines up correct, that's generally exactly what's going to happen and how we can foresee and predict what's going on in the market. And when all that happens, when it happens that this way, as the bonds go and the interest rates go up, we're at the time of recession, though. We can already tell real estate prices will go down from here. They're not going to continue going up. We've hit it. We've hit the wall. So we're officially there, which is another reason why I wouldn't be in houses right now. Not for another couple of years. If you want to get into houses, maybe 2 years out, unless you can buy something at a really, really dirt cheap price, and very likely you can, right? So if you do want to do that, there's plenty of opportunity out there. You just have to make sure that you're buying right, or you're flipping fast enough so the market doesn't catch you. Because at any point over the next few months, as we go into this election, like we did in the Obama election, where in August, everybody knew for sure Obama's coming in. That means all the Band-Aids are getting ripped off, all the lies that the Bush administration was saying about, and they all do it, every administration, they piece together and they fix this and they have everything propped up like a house of cards. And when they come out, all the cards come tumbling down. But it's temporary, all right? So it comes tumbling down, and then, hopefully we get, this is why we need to always go back and forth. I always had this theory that in my world, we should put Republicans in charge for 8 years, and then Democrats, Republicans, Democrats. Just keep them, just float them, and let them do 8 years of whatever they want, and then have the other party fix or balance it, and we probably have a more balanced situation. But that's not to me anyway. But that's the idea behind what I think is going to happen. What I think, where we are in the economy, how I figure this stuff out. Now for the rest of your life, you'll be able to take a look at this bond chart and be able to figure out. Now, if you want to look up bonds, it's called a 10-year bond. You can do a Google search for 10-year bond. Those are the keywords: 10-year bond. They have these things coded out, and the 10-year bond is called ZN. So whenever you see ZN, you're talking about that bond. So in this
John.
case, ZN equals F. Any questions?
Hello, John. My name is Tony.
Hey, Tony.
Hey, can I ask you about this contract deal that you mentioned about the notes? Like, if you could explain it again, one more time.
Yes.
How does it work?
Yeah. So what you're going to do is you're going to determine what I'm going to pay you for a note, which tells you how much you can offer for a property. And let me see if I can find this out real quick.
So John,
Yes.
so flipping the lots, just continue as normal, like usual, just try to get them cheaper, or wait for them to.
Well, we're always trying to get them cheaper, but just buy them with the understanding that you may have to offer owner financing on it, unless you're buying them. Unless you're buying these really cheap lots, which are always cash lots. They kind of never go away. These cash lots, they're always going to be cash lots. But once you get into 30,000 or more, then you're dealing with a buyer pool that's shrinking right now, and they need owner financing, and they're going to be requesting owner financing. And in my market right here, and we have a great market with plenty of buyers, and the land deals are starting to stack up. And sellers are starting to drop their prices, which I hadn't seen in the last year. They've been holding on steady. They're already getting to the point where they realize, oh, we're in trouble. Let's start dropping the price. Now, still, most of them are not dropping their price. Most of them aren't. They're still holding out. Well, you know, you educate those people along the way. You say, I can't buy this because we're at the top of the market prices, or actually we already topped out on the market and the market's already fallen. You're not going to get this price. You can tell people this with all this confidence because it won't happen. They won't, you know, they're not going to sell. And even if they did sell, they'll never call you. They have no reason to call you and tell you, I sold it, nah. And you're only going to do is say, oh, well, congratulations, bye. You know, so it's a no-lose situation for you to say, you're never going to sell at this price because the price has already gone down. So that's the idea behind it. So to come up with a price, you know, I always look at what can I sell the note for? All right. So the idea here is that I'm going to put a contract on a property, tie it up, immediately put it up for sale with owner financing and get a buyer. Basically, I'm going to create an owner finance note with that buyer, sell the note at closing. I'll come in and buy the note from you. And at closing, you're going to have the money I put on the table for you, which is enough money to pay the seller, and then you keep your profit. And the way you come up with this number, I'm going to use this as an example. Let's say that the retail prices in this subdivision are $60,000. All right. Well, how do I know what I have to buy this at? Well, I'm going to go ahead and put $10,000 because I know I can still get $10,000 around here for a down payment. That gives me a $50,000 loan, and then you know, it's going to still be 180 months, which is 15-year note at 11%. You could push it to 12 if you wanted to, but it pops the payment up to 600. So that means I'm purchasing this note for 37, but you also have the 10,000 down payment on the table. So your total cash on the table at closing is $47,000. $47,000. So you're selling it for 60 on owner financing. And so as long as you're buying it somewhere below 47 from the seller, you have this cash available to pay the seller. All right. So if you wanted to make $7,262, you would negotiate your seller on this property down to 40,000. That gives you the difference, 7,000. Now, there's probably going to be more on there because I use a yield of 18%. This is a safe yield to use, especially in times like this, because we don't know what's going to happen with the note market. We don't know if they're going to tighten it up more or what, or maybe they lessen it. You know, as interest rates go down, maybe the yield can come down and we can actually, you know, create some better notes here. But right now, I leave it at 18, but really it's probably around 16 to 17. So if we look at 16%, that means I'm actually putting 50,000 on the table instead of 47,000 and almost 51,000. All right. So if I can get you a quote at that, and we won't know until, you know, you actually get down to it. This is again why I say when you try to negotiate, or when you want to come up with a price to pay for a property, this is the amount, this is the setup you want on your calculator. Now, if we're at 100,000, let's say 120,000 sell price, and 10% of that's 12,000. But let's say we should be able to get 20,000 for that. This is above 1,000, so I like to keep whatever the sales price is. I kind of like to keep the monthly price at 1%, so that works here as well. In this case, this property right here would need to be bought at something less than 94,000 because that's how much money would be, you know, on the table for me when I do the note purchase here, and the down payment from the buyer that you add to that. So we got a total cash on the table at closing of 94,500 for which to buy the property and for you to take your fee and maybe a couple thousand in closing costs if you had to pay closing costs, which hopefully you don't. But that's the idea of how to do these and how to work this. I'm going to take this link and put it into the, it's in our training videos, by the way, but because I don't want you to have to go through it and look for it, I'll put it in the chat. Okay. And then you can grab it. Now, when you grab this, you've got to make a copy to your own Google Drive. The way you do that is come up to file, because you can't edit my sheet. Only I can edit this sheet. So you got to make a copy of it. To do that, when you go in here to that link, click File and click Make a Copy. And this will make a copy that's editable, that you can edit on your Google Drive. Okay. Any other questions?
John, in the spreadsheet, for some new investors like myself, what's not clear is how much money the investor makes. Is it accurate to say it's the down payment that the investor pockets, in addition to the difference between 94,525 and whatever was settled?
Well, the difference is whatever you can negotiate down to. So if I'm talking to a seller and I get them to take $50,000 cash for this property, okay, I'm going to make 44,000. So so it's just, you're just subtracting out whatever you're paying for the property to the seller. You're subtracting it from here, and you get everything else.
I see. So what about the row number 8, 9, sorry, row number 9, Excel sheet number 9.
Yeah, that's
so
a down payment.
Right. And that,
Go ahead.
who gets that?
It's in here, so you get it.
Oh, okay.
You as the investor get it,
Okay.
because it comes in as all the cash that comes in on the transaction at closing. So there's going to be there'll be earnest money in there. They usually subtract out the earnest money from the down payment and bring in that amount to complete their down payment amount. And then I buy the note from you and I'm sending money into the closing. So it's these two numbers right here basically that make up the cash that's going to be on the table for what you can pay a seller. So how do you figure out what to negotiate with a seller? Well, you go look on Zillow, come up with what you think that the retail price is in the area. Obviously, most people are trying to get cash and they're not selling. Okay, so you come in and you can offer that, or maybe even a little bit less. And let's say it's 130 and you offer 120. You even may offer 130, but it doesn't matter. You come in and offer this as owner financing, and all the buyers are going to flock to you. So now you put this deal together. So, but you're using this calculator to come up with how much should I give the seller. All right. So you just have to be below this number by whatever you want to make. So if you have a minimum of 10,000 that you want to walk away with, well, you have to be at 84,000 tops to the seller. I'm just going to take 10,000 off the 94. That tells me I can offer 84,000 to the seller for this property.
Okay.
Okay.
Understood. Thank you.
Mm-hmm. Any other questions? By the way, we have the wrap creator. And again, we've gone over this in videos, but that's all in this calculator, showing you how to create the underlying note with the seller and then your retail note with your end buyer, and you're making all the profit over here on the side. So we have different, we have this, all of this has actually been trained in depth into the owner finance area and the note at closing areas in the guide. So those are the guides, kind of the last guides that are in the guides area. If you want to look at all this owner financing stuff. Okay, great. Any other questions? We'll wrap it up. Fantastic. Thank you, everybody. We will see you back next month. Second Tuesday of every month we have these.
Well, thank you, John, again.
Thanks, Manuel, for your question. Good to see you again,
Yes, sir.
David.
Thank you, John.
Everybody else,
Thank you.
have a great week.
Thank you, John.
Have a great week.
Bye.